Welcome back. Is this the day or is this the week when we hit all-time highs on the Nifty? We're not too far away from that. 18,604 is the level that we're looking at. And the SGX Nifty indicating that we could perhaps even be at 18,400 this morning. But lots of stocks to talk about, so let's get straight to it. Coal India first up on our radar. Nigel, how did the numbers look?
Well, I'm going with a little bit of red actually, Sonia, because the numbers are a little lower than what we were working with. The sales number, well, that was lower. The EBITDA number, well, that was hit because the realizations were low and input costs were high, and the profit number as well missed estimates. The big reason is the blended realization that was expected to come in at around that 1830, 1850 odd mark. Well, that came in at around 1781. So there was a 3-4% miss on that front itself. It even missed Kotak's estimates. The e-auction volumes, which are normally, bulk of the profitability, well, that came down to around 10 to 11 million tons, or in terms of total contribution, it was down to around 7%, which was a little bit disappointing, a little lower than what the street was working with. Cost did spike up. Employee cost was higher. We'll have to find out how much of this was provisioning for the wage hike. While stripping ratio, well, that's a non-cash item, but that as well was higher. The sweetener came in, though, in the dividend form, and that will support the stock, actually, because 15 rupees dividend is what they have declared. And if you look at the futures plate, well, it's not really factoring in a big dividend out there. So that as well will be at play. Going with red for starters, and then we'll see a bit of a recovery, my guess is. Well, going across to Sonal. Sonal, BPCL numbers disappointing?
Well, yes, like the other oil marketing companies versus the poll, the reported numbers, of course, are much better because of that one-time grant. But other than that, it is a weak set. Revenues declined by 5%. This is the reported number that I'm talking about. This time around, the company has reported an EBITDA of 1,400 crore rupees, which compares with an expectation of a loss of 7,500 crore rupees. And it is improved on a quarter-on-quarter basis as well. Margins at 1.2%, net loss at 304 crore rupees versus an expectation of 7,500 crore rupees of loss. As I said, these reported numbers, they were aided by a one-time LPG grant of 5,582 crore rupees. The beat, so to say, after adjustments is only driven by the refining segment, like the peers as well. So GRMs came in at $16.8 per barrel versus $6 per barrel, which was estimated. Refinery throughput, however, was lower at 8.8 million metric tons versus an expectation of 10 as the number. Marketing segment continues to see big losses because the companies had not been able to take price hikes further. CLSA on the back of this has cut the target price to 405, calls it a weak quarter. It was a net loss this time around, and rebound in margins should allow improvement in second half. However, Jeffries says that OMCs are still making losses of 12 rupees per litre on fuel, and with the elections coming up across states, this is something that will continue because they will not be able to raise prices. So marketing losses could continue for all the OMCs as well. Back to you.
All right, Sonal, thanks very much for that. Metals are going to be in focus once again. Hindalco particularly, because Novelis has reported numbers, and numbers are a bit subpar, Nigel?
Well, the numbers were in line, but the outlook is muddled. Though you have the dollar index that's cooled off, which will be normally positive for base metal, so Hindalco could see a good recovery on that front. Let's run you through the numbers first. The adjusted EBITDA number in absolute terms as well as on a per ton basis, well, it was in line. In the last quarter, it came in at around $550 per ton. The problem is the near-term outlook. That's the next couple of quarters could be muddled because input costs are higher, some higher inventory as well. And that's why the management has guided that maybe you could see a pullback on an EBITDA per ton of close to around 75 to around $125 per ton. But they're saying it's only in the near term. They continue to hold on to that guidance of $525 per ton. That's the sustainable number that they're looking at. The other factors is their capex, well, they've scaled it back a little bit. Remember earlier they were working with around $1.3 to $1.6 billion. Now they've scaled it back closer to around $1 billion. The net debt number has spiked up a little bit. Even on a quarter-on-quarter basis, it was up a little bit. But the management said that in the second half of the year, you'll see working capital that is ballooned up to close to around $600 million. That'll get unbound, and that's why they're saying that the free cash flows will be around $500 million for the entire year. So the stock starts off in the red, and then we'll see a bit of a recovery. But Mangalam, from the consumer space as well, Godrej consumers numbers were disappointing.
Well, the street was bracing itself for a weak set because the company had guided for so in their second quarter update. But turns out that on the operational front, the weakness is a little more than expected. So at the revenue level, 3,400 crores is what the street was working with. The company's reported similar numbers out there as well. But EBITDA has come in at 542 crores. This compares with 560 odd crores. And as a result of which, the net profit has been lower as well. Volumes have dipped by 5%. The street was working with a dip of around 5 to 6 odd percent, so no problems there. But here's why the margins missed expectations. Gross margins declined by about 200 basis points. on higher raw material prices. But secondly, the company is upfronting its ad spends as well. Ad spends as a percentage of sales have come in at 8.4%. This compares with 6% itself. And as far as geographies are concerned, weakness in Indonesia continues. Africa as well, where we saw revenue growth in double digits, there was a sharp knock on the margins because of higher marketing spends. So in light of that, India has been relatively stable. The second half is more crucial, and that's where the company said that they expect gross margins to recover, but part of those gross margins will actually be put back into advertising. So to that extent, the commentary will be crucial to watch.
Okay, let's also track Paytm. Continues to report steep losses both on the EBITDA and net side. More importantly, the pre-IPO investor lock-in opens on the 15th of November, so all eyes will be on that. Abhishek Kothari has more details. Abhishek, over to you.
Well, this time around, they have beaten both the polls in terms of revenue as well as the net loss. So revenue is up 76.2% YOY and about 14% sequentially. It's higher at about 2,014 crore versus our poll of 1,842 crores. Now, net loss has widened YOY, but it's 25 crores below our poll. We are working with a number of 596 crores, but it has come in at around 572 crores. So contribution profit grew strongly on a YOY and quarter-on-quarter basis. The contribution profit margin has expanded to 44.1% versus 43.2% in the previous quarter. Brokerages are bearish on the stock given the fact that Morgan Stanley has an equal weight rating, CLSA with a sell rating, and Macquarie with an underperformance rating. However, they say that revenue trends are broadly in line, but operationally it's a strong quarter for Paytm. Back to you.
Okay, all right. Talking about that, lock-in period cooling off, Nykaa will be a stock that could be in focus today itself because their lock-in has expired. So keep an eye out on that one. Both the promoter and the non-promoter lock-in as well will be there. So we'll keep an eye out on that one. But Manglam, tell us about Jubilant FoodWorks.
Well, for Jubilant FoodWorks, it is pizza which is still in the making. That's how I would read the numbers, because while revenue and EBITDA were largely in line with street expectations and, gross margins declined by about 200 basis points, understandably because of cheese and vegetable inflation, the net profit was lower on account of higher depreciation and higher effective tax rate. So that is not really a worry. The Domino's like-for-like growth, which the company has replaced the same-store sales growth, has come in at 8.4%, which again is at the higher end of the street's expected band. Now, the problem is that there was no significant growth in their non-Domino's portfolio. The company said that they are looking to open 20 to 30 Popeye stores in this year itself, but they will assess unit economics and market fit of all the other verticals that they have, that's Hong's Kitchen and Ekdam Biryani. As far as Domino's itself is concerned, the positives are, they added about 76 stores versus 50 to 60 expected. They've guided for 250 stores being added, and the digital verticals doing well for the company. So things are good and some things are not so good. So as a result of which, I would say, the stock will see mild green today because of the mood of the street and the fact that it hasn't done well in the last few months.
All right. Pizza is not cooking that well, but let's see how things go from here. But Sonal's with us to tell us about Phoenix Mills and PI Industries and how they look this time. Sonal.
Well, it's a big green for both these stocks because strong set of numbers. Starting with Phoenix Mills, the consumption has crossed pre-COVID levels as well. Overall revenue growth of 75%, EBITDA up 104%, margin expansion of 800 basis points, and profit growth that has come in at 250% on a YY basis. This is versus last year. If we compare it with pre-COVID levels as well, the revenue growth has come in at 57%, EBITDA is up 81%, and profits have also gone higher. The company says that even retail consumption and the rental consumption is back to pre-COVID levels, or even better than that. Talking about PI Industries, revenue growth of 31%, EBITDA of 49%, margins have expanded by 200 basis points for the company at 24%, and profits have gone up by 46%, driven by both export and domestic markets for the company, where exports grew 29%. This is on a higher base, where volume growth in export markets came in at 25%, domestic growth also strong at 36%, volume growth came in at 31%, and newly launched brands is something that is contributing to significant growth for the company. So a green tick here as well.
All right. Thanks very much, Sonal, for that. Dr. Lal reported numbers as well, and that's an interesting company as always. We have the management also joining us a little later. Ekta is here to outline the numbers first for us. Ekta, hi.
Thanks for that. Well, you know, the devil was really in the details for Dr. Lal's, because on an operational reported basis, it was actually a good set of numbers. Revenue was up around 7%. The street was expecting around 11% growth, so that missed estimates. But the non-COVID-19 revenue was up 15% year on year. It was up 7% Q on Q. And the company has generated the highest ever Swasthfit revenue ever in a quarterly basis of around 95 crores, which is basically their preventive testing. Margins also improved to 27 versus 23.4% on a Q-on-Q basis, though it's low on a year-on-year basis simply because of the COVID-19 contribution same time last year. And profit came in line with estimates of around 74.5 odd crores. But brokerages continue to be cautious. Credit Suisse, Nomura, Morgan Stanley, Antique, all of them are cautious in terms of the higher amount of competitive intensity that they could face. And remember that revenue has been flat X of Suburban this quarter. So that might be a little bit of a dampener for Dr. Lal's, along with the fact that the valuations are extremely expensive for Dr. Lal's. So that's where the upside would probably be capped today.
Okay, thanks a lot for that. In fact, we will be discussing the second quarter earnings and the outlook going forward with Bharat Uppiliappan, who is the CEO of Dr. Lal PathLabs. That comes up at 8:35 a.m. So do stay tuned in for that. In the meantime, let's also tell you about Bosch's numbers. I'm going with red for Bosch because although the revenue growth was quite strong because of a recovery in the automotive market, the revenue growth was about 25.4%. It's the margins that continue to be under pressure, and it's a multi-quarter low for Bosch in terms of margins. Margins falling about 50 basis points year on year at 11.7%. The management says that it's higher material costs, higher other expenses, higher personnel costs that has impacted their margins this time. And also the top line growth was largely because the production volumes have recovered because of the inventory filling for the festive season and improvement in semiconductor supplies. So I guess because of the weakness in the operational performance, the stock could be under a bit of pressure today. But in case you missed out on any of these stocks, here's a quick recap. Stocks with positive news flow, there's Paytm, Jubilant Foodworks, Phoenix Mills and PI Industries. While stocks with negative news flow, there's Dr. Lal PathLabs, Coal India, BPCL, Hindalco, Godrej Consumer and Bosch.
Okay, all right. Well, those are all the top stocks we're tracking. But let's hop across to Manisha. She's joining in to tell us about all the action from the commodity space. Hi, Manisha. Morning.
Morning, Nigel. I'll start with the crude oil prices, which have come off its 2-month highs, and this is after China reaffirming commitment to zero COVID policy. Also, that the Brent futures trading margin has been hiked by nearly 5% overnight, and that has led to some profit taking by the longs as well. And then you had the EIA saying that the global demand growth forecast for the next year has been downgraded to 1.16 million barrels per day. And then the rise in U.S. crude inventories also weighed on. So there were some factors that led to profit taking that we saw in case of crude oil prices. But it is the metal prices that have continued to gain up. You have gold trading at 1-month highs, silver at a 4-month high, copper prices at a 2-month high, aluminum is trading at a 2-week highs as well, as the markets still believe that the U.S. rate hike in the next month is not going to be as aggressive, and the dollar index trading at a 1.5-month lows has been supportive too.
All right, Manisha, thank you very much for that. We'll take a quick break here. Deven Choksi of KR Choksi will join in for some fundamental stock chat. Later, we'll also connect with the management of Dr. Lal PathLabs, as just pointed out, on their second quarter earnings. Stay tuned for those conversations.